If you're over 65 and you own your home, don't assume the number printed on your property tax bill is automatically the lowest amount you qualify to pay. You may be paying more than you need to, not because your county necessarily calculated the bill wrong, but because a relief rule available where you live may simply not be applied to it. Across the country, senior property tax relief usually shows up through four main levers: an exemption, a freeze, a credit, or a deferral. None of them is universal. Your state, your income, your age, your primary residence, and how long you've owned the home all decide what may apply. To make this concrete, I'll use a hypothetical homeowner named Ruth in Texas. Ruth is fictional. The rules and the way they work are real. And near the end, I'll separate a freeze from a deferral because one creates no balance to repay while the other postpones the tax as a debt against the home. Let's start with the exemption. For this video, we're organizing the main forms of senior property tax relief into four practical levers, not a claim that no other property tax rule can exist. The first is the exemption. Lincoln Institute research identified some form of homestead exemption in 33 states. An exemption removes part of your home's value from the calculation your tax is figured on. It may lower the bill, but it does not send you a check, and it does not necessarily eliminate the tax. Who qualifies? Generally, you must own the home and live in it as your main residence, and be 62 or 65 depending on the state. Some versions add an income limit. Who usually does not? Renters and owners using the property as a second or vacation home. One note on sourcing. The state rules here come from official government sources, and the national counts from Lincoln and ITEP research, shown on screen as we go. Your action for the exemption. Search your county assessor or State Department of Revenue for the senior homestead exemption and check whether it's one-time, annual, or automatic, and confirm the deadline. Take Ruth's situation in Texas. At 65, a Texas homeowner gets an additional $60,000 senior exemption on the value used for school taxes. And that's on top of the general $140,000 exemption, which isn't created by turning 65. It already applies. So for a homeowner in Ruth's situation, the senior piece lowers the value the school tax is calculated on. The actual dollars saved depend on the local school district rate, which is exactly why we don't put one national number on it. And the rules shift by state. Colorado, for instance, exempts half of the first $200,000 of value, but only after 10 straight years in the home, a completely different eligibility gate. New York handles STAR differently. Beginning in 2026, eligible existing basic STAR exemption and credit recipients are upgraded automatically. But a homeowner not already receiving STAR still has to register for the STAR credit. And for exemptions like the Texas and Colorado examples, the quoted dollar amount is taxable value removed, not cash sent to the homeowner. The actual savings depend on the applicable tax rate and approval of the benefit. The exemption shrinks the base. The next lever doesn't shrink it. It freezes it. The second lever is the freeze, sometimes called a ceiling. Depending on the program, it can freeze your assessed value, or a defined portion of the tax itself, at the level of the year you qualify. Here's the honest boundary. A freeze creates no deferred balance to repay. But depending on the program, the final bill may still change because of tax rate increases, new improvements to the home, or other permitted adjustments. So a freeze protects against a defined kind of growth, not necessarily every rising dollar. For a homeowner in Ruth's situation, Texas offers a school tax ceiling. At 65, the school tax amount is held at the qualifying year's level, with no income test, though it can still rise for qualifying new improvements, or if state law changes how the ceiling is figured. Illinois shows the distinction that matters. Its senior freeze locks the assessed value, but if the local rate rises, the final bill can still move. And there, it's income gated at $75,000 for this tax year. And Washington breaks the "you must be 65" assumption. Its senior program starts at 61. So for your own state, check two things. What exactly is frozen, the value or the tax, and at what age? Here's the progression so far. An exemption may lower today's taxable base. A freeze mainly protects against a defined form of future growth. And the third lever works only after the tax has been calculated or paid. The third lever is the circuit breaker credit. And this is one that would not help Ruth in Texas. That's exactly the point. These are 4 possible forms of relief, not 4 benefits every homeowner receives. The name is the mechanism. When your property tax passes a set share of your income, the state returns part of it. It's income-based, not age-based, so higher-income homeowners usually phase out, and in ITEP's 2023 national survey, 5 states offered no income-based property tax relief at all, Texas among them. Here's the catch that changes how you claim it. A circuit breaker is usually not a discount on the next bill. It's a credit or rebate you get back later, most often on your state income tax return. Some states also extend these credits to renters, but renter eligibility is separate from homeowner exemptions and varies by state. Your action: search your State Department of Revenue for property tax credit or circuit breaker and check how the claim is filed. In ITEP's 2023 survey, Michigan and Minnesota were examples of states with homestead credit refunds claimed after the property tax burden was calculated. Step back for a second. The names vary by state: a ceiling here, a county exemption there, a credit somewhere else. So the useful question isn't the label, it's what the program actually does. Reduce the taxable base, limit future growth, refund part of the burden, or postpone the tax. The first 3 levers can reduce your net property tax burden. The 4th does something fundamentally different, and it's the one to be most careful with. The 4th lever is deferral, and this is the freeze versus deferral difference I promised, because they sound alike and they are not. A freeze limits a defined kind of growth and creates no balance to repay. A deferral does not erase the tax, it postpones it. In programs like the state examples we're covering, the deferred tax becomes debt, accrues interest, and is secured by a lien on the home. Repayment is triggered under the state's rules, commonly by a sale, a move, or death. In plain terms, a deferral is a loan against your house. For a homeowner in Ruth's situation, it could be an option worth weighing, if she were cash poor but house rich and wanted to stay rather than sell. But it can leave a balance attached to the home and reduce what heirs inherit. That's the part to weigh before signing. And the terms differ by state, so read them first. Texas lets a homeowner 65 and older defer, with the unpaid tax accruing 5% interest a year and the balance due about 180 days after they no longer own or live there. Illinois caps its deferral at $7,500 a year, charges 3%, and calls the balance due on sale, within a year of death or 90 days after eligibility ends. Oregon pays the county on November 15th, records a lien, and charges 6%, for homeowners 62 and up under a $70,000 income limit. Different terms, same shape. In all 3 of these examples, the deferred balance is secured by a lien. So a deferral is never free money and never savings. It's a tool with a cost, and that cost can reduce your home equity or what remains in your estate. 2 quick doors into the 4 levers you just learned, not a 5th kind of relief. First, long ownership can unlock more. Colorado's 10-year rule, and some Florida counties and cities that locally adopt an added exemption for seniors who've lived in the home at least 25 years, under value and income limits. That one is adopted locally, not guaranteed statewide. Second, if you're under the age line, a disability rating, veteran status, or surviving spouse status can open the very same exemptions and freezes. Washington, for instance, admits disabled homeowners of any age. Same levers, different doors in. So which of these is likely yours? Find yourself here. If you're 65 or older and your state has an age-based program with no income test, check the exemption or the freeze first. If your income is low or moderate relative to your tax, look for the circuit breaker credit on your state income tax return. If you've owned the home a long time, check a long residency program like Colorado's or a Florida county's. If your bill is high but your cash flow is tight, consider deferral, but only with the lien and the interest fully in mind. If you're under the age line, check disability, veteran, or survivor eligibility. And if you rent, look only for a renter's credit, and only where your state offers one. You don't need to check every category. Find the one path that fits your situation. Remember Ruth, our hypothetical Texas homeowner? Nothing about her house changed. What could change is the rule used to calculate or limit her tax. And that's the whole point. Not that every homeowner qualifies or saves the same amount, but that the number printed on the bill doesn't tell you whether every available relief option has actually been checked. So, you don't have to chase all four. Start with the one door that matches your situation, your county assessor, your state Department of Revenue, or your state tax return instructions for a circuit breaker credit. This is educational, not financial advice, and not tax advice, and every figure here is state-specific and may change. Verify your own eligibility, current amounts, and filing requirements with your county or state before relying on them. If it helps, tell me your state in the comments so I know which to cover next. Check the rule, not the slogan.